Hey, welcome to the first market message. I'm Bill Valentine. I want to talk about three things. I want to talk about where the markets are today. I also want to talk about the concept of a double dip. We hear a lot about that these days, and then we're going to address the concept of a bond bubble and whether there exists a bubble in Treasury bonds right now. First, let's start by taking a look at what's going on in the stock market. You know, a common question I get asked all the time is, when are you going to start making me some money? And that comes from clients, and I think they're half being silly, and at the same time they also wonder, when am I going to start making them some money? Well, I got to tell you, it's to use a metaphor to something that is near and dear to my heart. It's really hard to catch fish when they're not in the river. This has been a very, very tough environment to make any money in any asset class without taking extraordinary risks. And to that end, let's take a look at where the S&P 500 is for the last year. You can see by this orange line here that we're essentially back to where we were a year ago. We've made no progress in the stock market despite a brief run-up in the spring. Additionally, note that the pressure is downward. We've also got this line right here, the 200-day moving average, rolling over. When we've had periods in the past where the market's been falling, the 200-day has been rolling over, and the 50-day, this purple line, has been below the 200-day. That has presaged every bear market. Now, the existence of those conditions doesn't necessarily mean we're going to get a bear market. Two-thirds of the times we don't get a bear market, but every bear market is preceded by the combination of those conditions. And so we remain maximally bearish right now and have a market-neutral strategy in that respect. But you can look at other asset classes and get a similar picture. It's not just the United States stock market. If you take a look at the overseas markets, the world ex-US, that orange line again takes you back, no progress for the last 12 months. Look at commodities with something like the DJP, the ETF that looks at commodities. Where are we in the DJP? Virtually no growth in commodities for the last 12 months. The one major asset class that's bucking this trend, surprisingly, is actually REITs, real estate investment trusts. Commercial, industrial, and multifamily housing properties are back to where they were 6 months ago, but notably higher than where they were 12 months ago. Second thing I want to talk about is the concept of the double dip. You know, I can't tell you how many times I've heard somebody say or read somebody who's saying the exact same phrase everyone seems to be using, which is, I don't think we'll see a double dip. When you Google that term, I don't think we'll see a double dip. What you'll see is on this page, and I'm just scrolling down here, you'll see 6 full pages of links containing articles that use that expression. I don't think we'll see a double dip. I think it's rather arrogant on the part of a lot of people that use that expression. We have to be very careful when we make economic predictions. Predicting the economy 9 months out in advance, which would be the likely period that a double dip would happen, is like trying to predict the weather 3 months from now. So the mere appearance of that phrase over and over and over gives this investment manager cause to believe maybe we'll see that exact thing, the double dip. Finally, is there a bubble in treasuries? Well, I've been talking a long time about the bubble in treasuries. There's been a lot of interest in treasury bonds, driving bonds back to the lows that they haven't seen since the peak of the crisis in early 2009, and then prior to that back until you have to go down 50 to 60 years back to find rates this low, meaning bond prices this high. There is a bubble of sorts, but I think that term gets abused. It seems like we've missed the last 3 bubbles. We didn't see the tech bubble coming, and that kicked us in the butt. Then we didn't see the real estate bubble coming, and that kicked us in the butt. Then the financial crisis was sort of the 3rd bubble in less than 15 years, and as a result, we have a hypersensitivity now. Everyone's bubble spotting. Are treasuries in a bubble? Is gold in a bubble? Is China in a bubble? We have to be careful in spotting bubbles. Bubbles don't necessarily look and act identically across the board. The treasury bubble today doesn't necessarily have to pop tomorrow. So I'd be reluctant to jump right on the train of the bandwagon of anti-treasury bonds now. Our best investment this quarter and for the last 4 or 5 months is the TMF, which is triple long the 30-year treasury bill. You can see the chart of it right here. Performed very well. So eventually that'll reverse itself, but very, very hard to say when that'll happen. Quick reminder of the great expression that the markets can remain irrational longer than you can remain solvent. I'm Bill Valentine. This has been today's market message.